2018 in the session. Can we have roll call, please?
Mugrauer.
Here.
Rousey. Eschel.
Here.
Miller.
Here.
Allison Osby. Berman.
Here.
O'Meary. Present 4.
All right, we'll start with the new resolution 19-471. Create an ad hoc committee to review alternatives to special assessments for funding road and sidewalk construction.
So moved.
Doesn't look like anybody in the audience to speak on that issue, only staff I see. So we have a motion. Can we get a second?
Second.
All right, any discussion on creating an ad hoc committee to review alternatives to special assessments? I guess we have some candidates already, Mr. Rowland?
Yeah, I've got a handout for you to take home with you, and I think you may have been emailed this, but
Yep.
I'll make sure you at least have the applicants to date. Then Friday, we'll give you another, we'll just keep feeding them to you as we get them. The deadline will be Friday, August 30th at, is it 10 or noon? I believe.
I think it was noon when you
I think it
decided
was
on.
noon, and you'll get everybody at that.
Okay.
I think there's just one thing I'd like to talk about a little bit, and then I'll let him move on. I think, are we at 25% non-citizens?
That's
Is that
correct.
right?
Non-resident.
I just for safety factors, does anybody have a problem if we move that up to 35%? We get to pick the candidates, so we've got ultimate control, so I don't see how giving us flexibility now, because we're gonna pick the candidates anyway, so I don't know how it would hurt to have 35% right now and then take a look at the pool. I just don't wanna handcuff us down the road for a good candidate, that's all.
Go ahead.
I think for once, for a long time, I'm going to disagree with you, Mr. Miller. So I actually would want to stick to the 25% because I think, first and foremost, this is about Oshkosh residents' special assessments. And I understand, that we have business owners that don't live in the community, and they would be a good attribute. But I think at first we have to keep front and center that this is about the residents of Oshkosh. So, and I think the 25% is an acknowledgement of those non-residents already. So I'd prefer to keep it at that. I'd also like to suggest that we add a second council person to the mix so that we have a kind of a balance of the elected officials on that committee, because, it might be beneficial for us to come to common ground if we can have possibly a for or against, like we, in regards to, because of how how this last time turned out, it might be good to bridge that a little bit as well. So I'd like to make a motion to amend. Mark, would you like to?
What I can offer you is, city attorney and I drafted this, and I consulted with the mayor after it was drafted. I think the intent of what you're proposing is already there.
Okay.
Which
part?
It says and be comprised of members generally representing the following categories. So there are people.
Okay.
So you can choose to have more than one council member already. That's my interpretation. That'll really be ultimately up to council when you do the appointments. So I would say you already have that capability. So
Okay.
that's that's my only observation.
That was going to be my question. We don't really need an amendment for this at this point. We're just voting on to start and form an ad hoc committee, and we can make changes as we move along, correct?
Yeah.
The particular membership was drafted that way because we anticipated that you may want some flexibility.
Sure.
Okay. So we won't need to take any amendments. We're just voting tonight on forming an ad hoc committee. We can always kind of make adjustments to that, as Mr. Rolfe said, at the next council meeting when we appoint the members or
I like the
commissioners.
for and against, I do.
Yeah.
So, and I also think that actually speaks to your request about 35%.
Right.
Because it's still, even though I would be opposed to it, it still allows the committee to be able to generally kind of make that decision if there's a benefit to it.
Okay. Well, the mayor just made it. Thank you. So she'll be here in attendance, no problem. So on the floor, just to bring the mayor up to speed, is we have a motion and a second to create the ad hoc committee. There was a little discussion on opening it from 25% to 35%. The city manager has stated we have that flexibility when it comes to council to appoint. And Councilmember Peschel also mentioned about possibly having a second council member maybe one that voted for the transportation fee and one that voted against the transportation fee might make sense. And we currently have 3 candidates that have applied to be on that ad hoc committee. So at this point on, we have a motion and a second, the roll call vote for Resolution 19-471.
McGrower,
Aye.
Peschel,
Aye.
Miller,
Aye.
Herman,
Aye.
Mayor Palmieri,
Aye.
carried 5.
Okay, I'll make a motion to adjourn the special council meeting.
So moved.
All in favor?
Or second, whatever. Aye.
Aye.
We don't need a second for that. All right, I'll turn it over to the mayor to get our budget workshop started.
I just have one announcement. Deb wanted to apologize. She had a conflict. She could not be here. Obviously, she's away at a conference that was on the calendar, but she did want me to let everybody know. She apologizes, but it is business.
She'll find some delightful viewing on Oshkosh Media and catch up quickly. I know she will.
Absolutely.
Also, Councilmember Krause had a family matter that came up, and he will not be able to attend this evening. All right, so we will commence the August 21 Budget Workshop number 2, I believe we're on. And I'll turn it over to City Manager.
And I'm going to turn it right over to Finance Director Russ Van Gompel. As many of you know, Russ has accepted the permanent position. We'll be starting with us full-time on right after, on September 1, so with Labor Day. Russ has the index, the layout of our agenda for today. And I'm just going to let Russ take it over and go through the presentation for tonight, which is all in your packet that has the little graphic in the front.
Thanks, Mr. City Manager. The agenda is really identified on page 3, and this is kind of following what we've done in the past. But before we start talking about our 2020 budget, the tradition for the city of Oshkosh has been to do a quick review on 2018, just to kind of go through your annual financial report, which is a separate document. The statement is actually prepared by the city, but we also have an audit done by Clifton Larson Allen. And part of that process is to have a short presentation by CLA to just kind of give you a brief overview of where we're at. So I will, at this time, ask John to join us. And John, if you could just walk us through the audit report.
Absolutely, thank you. Well, good afternoon again. Nice to see everybody again this year. And again, thanks Russ for that introduction and exactly what he said. This is kind of an informal discussion. Interrupt me if you want to talk about certain things. What I'll do is I'll go through a few pages of the annual financial report, the CAFR itself and the document itself, and then I'll point out some things in the management letter as well, the management communication letter. So again, interrupt me if you would like to talk in more detail on any of the pages that I'm in. But again, you'll notice the name change. That's number one. Schenck did merge in with Clifton Larson Allen, CLA. So again, teams are all the same, offices are all the same, no difference other than the name. So again, that transition shouldn't affect your side at all as far as any kind of client issues. So hopefully only good things, benefits from that process. But as we look through the table of contents, your comprehensive annual financial report or annual financial reports really segregate into a couple different components. There's the introductory section, and that's really all of your letters and your information, the letter of transmittal, which kind of begins the report itself. Then it goes down into the independent auditors report on page 10, and that's really, those 3 pages are really, the 2 to 3 pages are really the outcome of the external audit. So that's our opinion on that. So if you want to turn to that on page 10. Page 10 really begins that independent auditors report, and on the bottom of that page you'll see the opinions section. And that's really the opinion. We issued an unmodified opinion on the city's financial statements that are the rest of this book, and the footnotes there attached. And again, that's exactly what an external audit strives to achieve, is an unmodified opinion. So in our opinion, the financial statements referred to above present fairly in all material respects the representative financial position of the governmental activities, the business type activities, the discretely presented component unit, each major fund, and the aggregate remaining fund information of the city as of December 31, 2018. So that's exactly what the opinion states. The next section starts on page 13, and that entire section is the Mdna, or Management Discussion and Analysis. And what that is trying to do, that's a document prepared by the city entirely, and what that's trying to do is take the information in this financial report, really the rest of the book, and turn it into plain language. Here's what you need to know. So very important section, both for city council, both for users, citizens, and the like, is to read through that. It goes through the financial highlights in plain English, what happened, why did things change, plus or minus, and so forth. So again, brings in some of the summary financial information in table form, just a little bit easier to understand, a little bit more concise, but a real repeat of the basic financial statements. The basic financial statements, the rest of the document starts on page 23. And I won't go through every one of these, but I will just kind of explain each one. Statement of net position is your government-wide basic financial statements. This brings in the entire city as a whole, and the full accrual accounting based on GASB 34 for quite some time now. And what this does is it really reports two columns, governmental activities and business type activities. And that's really the two columns that are made up of the city. You have a far right column called component unit. That's a separate entity that's closely related to the city, the redevelopment authority. That's being brought in on the far right on the other side of the totals. So you can see this is the statement of net position. This is your assets on the top. You have deferred outflows of resources, and then you have your liabilities and deferred inflows, all leading towards the bottom of net position. So that's really the citywide net position. You can see the governmental activities as $118,878,000. Three components of that: net investment of capital assets, $43,000. So again, of the 118 million, 43 million, is really tied up in your assets. That's your buildings, your equipment, and so forth in the governmental activities. Then you have a 27 million in restricted. Again, these are outside restrictions, outside the city itself, that are putting restrictions on that money. And then you're left with 47,114,000 as unrestricted. So that's really the kind of the number you want to focus on as far as your governmental activities. Same way the business type activities, you have 215 million in total net position. 140 million is in net investment of capital assets, 16 million restricted, and you're left with 58 million in unrestricted carried over into the 19 fiscal year. Turn to page 24, 25. That's your statement of activities. And again, what the statement of activities is another way to think of it is as an income statement, but it's an income statement on its side. So you can see it starts with expenses in your functions there. All of your expenses are in the leftmost column. And then the rest of the columns are the revenues, are the charges for services, operating grants, and contributions. So what it's doing is it's saying by function, here's how much you spent, here's how it was funded. So you can see the total governmental activities and business type activities column in total there on the far left-hand column of the page 25. You can see that most of those, all but one, is a negative, meaning that you've spent more than your program revenues have provided. Well, then the rest of the story is down those two columns on page 25 on the bottom, which is here's how those deficits were funded. Well, you can see that all your property taxes are listed there, your federal grants are listed there, and your change in net position was 19,127,000 in the governmental activities and 17,005,000 in your business type activities. So you can see from the previous net position how it changed from last year to this year, 2008. Any questions on those government-wide statements? Page 26, 27 really goes through the same information, but now it takes that accrual, that full accrual accounting out of the equation. So this is more the statements that you would budget on. This is more just revenues and expenditures, and your buildings and so forth and your liabilities are not on these statements. This is a little bit more in line with how you budget. And again, you can see it's a balance sheet, so you have assets, liabilities, and fund balances. So I'll just kind of focus right down to the fund balance. So in the general fund, your main operating fund of the city, you have total fund balance of $12,062,000. Part of that, a smaller part of that, $83,000, is non-spendable, meaning that it's in a form that you cannot spend, usually in inventories or prepaid items. In this case, it is 100% inventories and prepaid items. You can see that on the top of the asset section there. And then you're left with assigned fund balance. And again, if you kind of draw a line beneath restricted and committed, you don't have any restricted or committed this year in the general fund, but you can kind of draw a line there, and everything below that is really at the discretion of the city. So assigned fund balance is just saying, hey, of the $12,062,000 that we have in fund balance, $161,000 is earmarked for various purposes. So you do that as the normal course of your budget and so forth. You kind of earmark some funds. That's what you're looking at there. And then you're left with the unassigned $11,817,000. That carried over in the general fund into 2019. You can see all the other major funds. Debt service has $1,092,000 in restricted fund balance, and then special assessment improvement, $1,181,000 in unassigned. Your other governmental funds column is all the other non-major governmental funds, which is located in the back of the document. So, bringing the total fund balances of your governmental activities of $61,968.
Just a quick question.
Yes.
On page 26, under assets, most of these are pretty generic references, but then there's one I haven't seen before, deposit with GoHNI, and that's all zeros. What is that?
Actually, there's $204,380 in the other governmental funds. And if you
okay.
turn to, let me find it real quick for you so you can see that on page 1. Bear with me for a second here. Starts on page 83 is where your non-major balance sheet starts. So you can kind of see $204,000 in your special revenue fund. And again, the specifics of exactly what that stands for, do you have that?
So we have a CD that we hold for GoHNI. That's what that CD is. It's collateral for their loan.
Yeah, the reason it specifies is it's a little bit different than your normal cash. That's why it's separated there. Otherwise, normally you just roll that up into cash investments. But anything that's a little bit different or a little bit separate, we want to point out separately on a separate line. So. Question? Now you can kind of see, as we look through that, you can see on page 83 and all the rest of them, how it all ties into that column. So a lot of funds are in that one column there, other governmental funds. Those are all your non-major funds. So then on page 29 is your statement of revenues, expenditures, and changes in fund balance of your governmental funds. So this is the same major funds, and you're seeing the income statement. And I won't go through every line item here. You can see your revenues and expenditures. But just other than to say that this is the change in fund balances from beginning at the end of 17 and the end of 18. So
I guess I would point out that Councilmember Miller asked me this afternoon what our net fund balance change was, and it's that $1,685,560. So that was a very good year. So you called it right, because you said I thought it was $1.6 million.
Well,
So
we
were
both
there.
did.
So that represents a very good year.
And in page 29 too, under our revenues, the miscellaneous, a little under $1 million. What would that consist of? The most miscellaneous?
miscellaneous is miscellaneous revenue is kind of encompassing all of your interest income and sale of things. The exact detail I don't have off the top of my head, but it's basically all of your anything that wouldn't fall under taxes, special assessments, intergovernmental. So you generally have quite a bit in there. Interest income is probably the primary component of that. But a lot of different things, rents, any kind of rents fall into that miscellaneous category. And those are pretty set categories. That's not, you don't have a lot of you don't have a lot of room to say, well, it's one category or the other. Those are pretty much set based on the Department of Revenue State Report. I don't know if you have anything to add as far as the specifics of miscellaneous.
Pretty much hit it on the head.
Interest.
Can you give like some examples of what that might be?
Interest, like the interest income that we would earn on like our CDs that we invest in, any of our investments that we would have, that tends to be a big number.
And there's interest on special assessments.
Correct.
Oh, right.
There's
That
well.
money does accrue
Okay, that's where
to
that
the
is.
city, because the
Okay.
city's advancing those funds, so it goes back to the general fund. And you'll see that in the mid-year report as well. So I ran to the mid-year report because there's a little more detail in the mid-year report, and that's pretty much it. Those two and a little bit of rent, but we're landlords to very few properties, so we don't get a lot of that.
I have a question. So notes, basically your notes to basic financial statement or your, part of your management report or board report. But obviously this is the longest notes to basic financial statements I've ever seen, but,
Welcome to the world of Gatsby.
but, are there any significant footnotes that have changed, year over year that you'd like to point out without us having to go through the minutia?
Yeah, I mean, there is changes every year to these, obviously.
Significant, I'm
Yeah,
looking for.
They're adding, Gatsby's probably adding footnotes 2 pages every single year.
Okay.
The biggest change is the inclusion of, in 18, the inclusion of the life insurance component of OPEB and your WRS. We've talked about that in the past, the WRS component. Those are 2 pages each in here, and they're probably one of the most complex footnotes anyone's gonna see and probably not understand. And those are the biggest changes, because what it's doing is it's, for the first time, reporting some of those liabilities on your city financials. Not just yours, all governmental, city, and municipal financials.
Do you project in your notes and your footnotes, pension liabilities, long-term and things like that? So that's all denoted in here? And-
Yes, we don't
Okay.
project per se, it's not a projection, it is based on the GASB liability rules. It's as of December 31, 2018, this is the liability. As of December 31, 18, this is your asset for WRS if it happens to be an asset. Yes, correct. That's
Okay,
all spelled
great.
out right in those footnotes.
For everybody that's not familiar with this, you can hide a Buick in the footnotes, so that's where you want to look a little bit, so.
Well,
And the
And
notes-
I'm not implying you are, but I'm just.
Cadillacs.
That's where you want to look, though.
Yeah.
Because if there's any concerns, they're going to be buried in there, and there's a lot. So that does require.
Disclosed is the right term.
Nothing's buried, everything's right there for you to read.
It's
But-
disclosed, but you got to read it
But if you
all.
go to page 68 and 69,
Thanks.
that's where the actuarial assumption for your pension liability, I think it starts in that section with the police and fire and then the other benefits. And then I would also note, you might find it interesting, there's also a footnote number 4 that starts on page 76 that talks about tax increment financing districts. So you might find that kind of helpful.
So internally, and I'm getting off topic here, and I'll make this my last one, but, so do we project for the council, again, the pension liabilities, the healthcare liabilities, all of that stuff, do we do anything long-term, maybe like 5, 6, 7 years out? Do we do that internally? And it's not fair to ask you, Russ, because you've only been here a little while, but is that something?
Well, several years ago, didn't we pay off that liability to the state, Mr. Roloff?
We
Funded.
paid off our WRS liability. The
Right.
OPEB is a relatively new thing,
Okay.
and it reflects more about health insurance. We don't offer health insurance benefits like a lot of public agencies do. There are several public agencies that will provide health insurance and paid by the city for any number of years up to usually Medicare eligibility. We don't do that. What we do is we offer it to employees at their cost, but because those retirees are in the same plan as regular employees, if they were out in the market getting insurance on their own, there's a difference between what we're offering it to them and what they'd be paying for. And because they're part of our larger group, that's the liability that technically we own.
Correct.
A solution to that would be we could charge a different retiree rate. We currently don't do that. That's something we could do. But this liability, compared to some of your other clients, this is
Yeah, exactly
Minimal.
right. I think you said it very well. If you had a robust other post-employment benefit where you have actual real dollars being paid out either by stipend, by a set amount, or by a rate, then that's real dollars that you have to project. This is more of a reporting only. Your actuary determines this. The liability you see is strictly the implicit rate study. That's exactly what he's talking about. That means that if you have retirees on your health plan, they are technically, there's a cost difference between that and not having them on. That's a subsidy, and that's what's being recorded. That's why your liability is actually, I think it's $2 million recorded, where you have a school district a fraction of the size, and they could have $10 million because of the benefits are complete. And that's why the projection really, when you're dealing with a reporting only, meaning it's showing up on an annual basis, I'm not sure projections would be useful at that
No,
point,
no.
because again, it.
Again,
changes.
separate, I don't expect the projections to be here, but I just want to know if,
No, good
So,
point, yeah.
okay.
Good discussion.
They're new reports, but yeah, I feel very confident we're managing those very well.
and anything, I didn't read over the management letter, anything significant there?
Yeah, we'll get to that in a
Okay,
second. Yep,
sorry.
perfect, no
Very-
problem. So the notes themselves, I'll just kind of summarize the annual financial report here. The notes themselves, we talk a lot about the details and particular ones, but really they are designed to really support those financial statements. So if you were to look through the front to back of the footnotes, they are logically in order of what's important in your financial statements. So you'll see the cash footnote, which will detail the cash line item on the numbers I just went through, the statements I just went through. You'll see all the detail of exactly what's made up of cash, what investments you have, your risks involved in that. Likewise, all your special assessments has a footnote, and so on and so forth. So every single section, long-term debt as well, lists all of your long-term debt, all of your maturity schedules. So all of that information is all there for you. So again, it's comprehensive, it's many, many pages, but if you look through each one of those, it really supports all those financial statements.
I noticed that pages
That's something completely separate. Yep.
107 through like about 112 list out our TIF separately. If I was, and maybe city manager can talk about this, looking for any reflection of any of our look-back TIFs and where we're at in the look-back on those specific TIFs that have that in the redevelopment agreement, would that be reflected in here also?
No, that would not. Look-backs are a relatively new thing. In fact, as we were talking with Ellers, we were one of the first communities in the state, if not the first, to do look-back provisions. We have look-back provisions in 4 of our TIFs, and they start with TIF 28, the beach building, TIF 30, Washington building, TIF 32, granary, and TIF 36, just approved merge. The look-back doesn't kick in until the earliest is 2027 with any of those, because it's generally a 10-year, we start to look back at 10 years. But it's a relatively new concept, but those are all identified in our agreement. And I think Russ is going to go through some of the TIFs later on, because that is part of our agenda. But I ask, because I appreciate you letting me know in advance, because I was able to get that information.
So the earliest look-back trigger date would be the 2027
On
what?
beach building next door,
2027,
2027.
okay.
The schedule that you see in your annual financial report is basically just a snapshot of what happened in 2018 as far as the allocation of taxes into the various funds and the expenditures for various funds. A little bit later on, we're just going to give you a little better recap of what we see is happening on the cash side of things, but this just is representing what came in, what came out, and where we're at in fund balance for what we call capital projects funds for the tax increment districts.
Yeah, very, very well said. I mean, again, the footnote or the star next to any kind of discussion on the TIFs in the financial statements themselves is, it doesn't tell the whole picture, because a TIF is a financing arrangement. It needs more detail. That's why you'll see in the footnote of the TIF districts that Russ pointed out, you'll see a lot more information of how that fund balance and how that current year activity ties to cumulative and ties to where you're at as far as cumulative unreimbursed project costs and things like that. None of that can be or is allowed to be reflected on your basic financial statements. That is very focused on current year activity and current year fund balance where you ended. So.
And later on, you'll see a report from Russ with the TIF cash balance summary, and the 12/31/18 balances that you'll see in Russ's report match up with the audit. So you'll see that there's a correlation between the two. I did a quick check before I made that statement.
Good questions. Any other questions on this annual financial report? Otherwise, I'll go into the management.
John, if I could just add one more thing, and I know we've given you a lot of information tonight. You know, as finance director, I would encourage you to read the introductory letter and the management discussion and analysis, which John kind of talked about putting numbers into layman's terms. But at any point, if you got questions about any of the numbers in here, please contact me, and through my staff, we'll get you the answers. Because even if you're involved in other businesses and other accounting activities, unfortunately, governmental accounting is kind of a separate animal. We don't talk about earnings. We talk about fund balance. We don't do expenses. We do expenditures. And except for your business activities or your enterprise funds, we don't do depreciation. It's just how we account for assets and liabilities, inflow of sources and outflow of resources. So it is kind of unique and kind of different. If you do have any questions, feel free to shoot me an email, give me a call, and we can get you the answers. So also as part of this is the communication from our auditing firm, and that's the separate document. So John, take it from there.
Absolutely. It is a separate document. It's stapled. And this is exactly what Russ said, and that is just a communication letter. It sums up kind of what we just talked about that's in the annual financial report of the CAFR. Page 1 through, I believe it is 4, is really that letter. So it's just a kind of extension of the opinion where it kind of goes through the standards that we followed, the planning, the timing, the scope of the audit, goes through any significant audit findings, and if there were any, they would be listed in there. Again, things went very well as far as the audit is concerned, so you won't read a whole lot in there, but this is the section. You know, again, read the Mdna, the management discussion analysis, read the letter, the transmittal letter. Also read page 1 through 4 of the management communication letter. This is where you're going to read any kind of issues. And it goes through a lot of information as well. It goes through your estimates on top of page 3. We just kind of point out on those little arrows there all of the estimates that are contained in your financial statements, what factors we looked at, what assumptions we looked at. It goes through any corrections we made as part of the audit process, and then all the other bullets there as far as any other matters we want you to know about. The second section of this really kind of a little more detail of what we talked about already. Fund balances goes through kind of a repeat of exactly what we talked about, but a little more detail. Read through that. It just kind of gives the history of the fund balance, or the summary or more detail of the fund balance. On the bottom of page 6, I would just point out one thing. The unassigned general fund balance of $11,817,000 that we talked about represents a balance of about 26.68% of your annual general fund budget. Again, as a general guideline, and this is a huge underline there, a general guideline, cities should maintain a minimum of 2 months expenditures. That represents about 16.67%. We always say anywhere from 15 to 25, upper end's probably 30%. What we run into in practice is a good range of fund balance when you take that fund balance as a percentage of your expenditures. So you are right in line with that. Your very healthy fund balance in your general fund. Obviously, you had a good year as we talked about. So that increased your fund balance up above that 25%. So again, from a financial health standpoint, excellent fund balance in general fund.
No, yes, I do. I'm sorry. I think the important thing to understand is, if council wanted to tap into fund balance, and I understand we do have a formal fund balance policy, but the difficulty in doing that is it's really a one-time source of revenue. And if you use it one year, it's kind of hard to use that again the following year. So, a conservative approach is to try to minimize the use of fund balance, but yet it's important to have for, cash flow purposes and unanticipated expenditures. Unfortunately, we live in Wisconsin, and we have weather events that may impact operations that aren't budgeted for, and that's why you want to have a healthy fund balance. And it also goes into the item we talked about at the first workshop is your rating on your community for issuance of debt. So the more healthier fund balance you have, the better chance you have of getting a very good rating from the rating agencies on the issuance of debt.
Any questions on that? The rest of the management communication letter on page 7 there just kind of goes through each of your major funds and your major activities. I won't read through every one of those. It's just going through all the income statements for the business type activities, all the fund balances for your governmental activities, all the way through. So I highly encourage you to kind of look at that. It's just a repeat right off your financial report, a little bit easier to read in this document. But on page 13 is kind of that section where we're kind of letting you know about some new accounting standards coming out. And there's really two major ones. There's more than two, but two are most applicable and most current. The accounting and reporting for leases, GASB statement number 87 is coming up. Again, this is changing the lease standards. There used to be 2 lease standards. Now they're kind of encompassing them into one, and they're also clarifying a number of the items. So making it a little bit easier to understand as far as the accounting and reporting for leases. The takeaways to the city is simply, if there is leases that you're leasing equipment and it's for a financing type situation, you need to really evaluate how this lease GASB affects you. Because what they're trying to do is they're trying to say, it doesn't matter if it's capital operating in the old rules, it used to be a capital lease or an operating lease. Now they're saying, if it's a lease to finance something, it's a liability to the city, and it should be on your financial statement. Most cities, isn't going to really affect too much because you lease equipment now, it's already a lease most likely. Where you run into situations that this could come into play is if you have very complicated, very unique lease arrangements, which we do run into once in a while, and in that sense. What it will do though is it will change the reporting side of it. So the footnotes we talked about, there'll be a couple more pages in this book next year just related to leases, all in the effort for full disclosure and make it more understandable. Hopefully that's the ultimate result of that. I should hope so. The one change to the GASB 87 that will possibly affect and is brand new is when you lease things to other entities. So if you lease land, you lease buildings, you lease equipment, other entities, both private or public sector. Then there's new rules, whereas in the past the rules that currently exist today, it's silent on that. When you get a lease payment in, you would record that as revenue. Now that will change. There's going to be a present value calculation, potentially receivable type situation where you have a long-term lease coming in.
What about internally? If we lease something internally within our own organization, same rules apply?
No.
Okay, that's
External only.
okay. Thank you.
So again, that may not even affect you, but
So would that apply to the Grand Opera House?
We own the building, but we give
We lease
them-
it out to the foundation, right?
That's probably an example that we might have to look at, yeah.
and materiality comes in, so it depends on how much it is. It depends on what the terms of that lease.
We get
So
to that.
that's certainly not going to
Yeah.
apply because it's immaterial.
It is a lease, but as Jennifer said, it's $1.
Oh.
We lease out,
Gotcha.
we lease out our surplus industrial park land to local farmers So there's probably a little impact, but we're not big leasers, so it's probably not gonna be a lot. As you started to say, I was like, okay, I was trying to process what leases do we have, but they're pretty minimal.
Yeah, prior to Russ getting here, we kind of did a little bit of a mini inventory of what leases we have, so
Good.
kind of started that process already.
Excellent. That was my next point, is simply just take an inventory, start gathering that, and then we can go through that during the audit process.
And
Yeah.
equipment-wise,
The only big, well, he said it's external leases, not internal leases, so the biggest lease we had internally was, were the golf carts before when Lakeshore was still open. I'm trying to think, I can't think of, we debated back and forth about different leases, but we're not big on the lease side.
last time I remember, I think from last year's financials, there was only one, there was a pickup truck for one division or department. It was a, I don't remember which utility it was for. For
Yeah,
some reason, I didn't remember if that was still on the books or if that had come off yet.
yeah, I can't recall, but what,
We don't have any equipment, major equipment is all cash purchase or, is all purchase, not lease, as far as we know.
yeah.
And there could be examples where there's a few leases here and there. There could be things that you enter into in the next year that we don't know about right now that could fall under that. The takeaways here is just to do that inventory and.
Some of the software stuff falls into some of those that are requirements now, that you probably wouldn't even consider to be a lease. So
Right.
those things will fall into that. I know like our copy machines, those are all on lease, so
But
that
those
will
don't
fall.
qualify here, right?
They could.
They could.
They
They
could,
could.
yes. It all, like I said, they're not, it used to not. So there used to be an operating lease. No, it's not. Now they're saying, it doesn't matter. If you're leasing a piece of equipment and there's an ownership type situation there where you're financing that over time, that could qualify for this. So again, depends on the factors that GASB sets forth. And that's why we have to take that inventory and then apply that.
Not that
I think I already know the answer to this, but we have no 179 advantages or anything like that, all goes away. Okay.
Okay.
The final one is on bottom page 13.
Driving me nuts.
Is accounting and reporting for fiduciary activities. This is 84. And what this is doing is really changing the way fiduciary funds are reported. So again, take an inventory of anything that you have fiduciary in nature, pension and other employment benefit trust funds, investment trust funds, private purpose trust funds, custodial funds, anything like that. Where some potential fiduciary activities that would apply under this GASB would be tax collection funds, cemetery trust funds, if anything like that exists. And what we just say is,
We have a lot.
Yeah, you do that
most
reporting.
municipalities do. So what you gotta do is simply start making a list of those, start identifying those, start identifying the purpose of those. And, again, the takeaways aren't gonna be too significant. A couple more pages related to the footnotes on this. And then they're doing away with some classifications of the funds. And so it'll just show up as a little bit different on your financial statements. I don't see a huge difference there. I don't see anything reclassified, but potentially some of that activity will have to get reclassified into the general fund. Still be recorded, you'll still see it, it'll just be in a different spot. So,
Okay.
don't wanna scare you, don't wanna complicate you on this. This isn't gonna be a significant thing for your financial statements, but you will see some new things. That's why we're pointing it out.
What's the number one way we can get our debt rating up, in your opinion?
There's a lot of different factors. I think Russ pointed out the big one is fund balance. I think fund balance, when you talk about governments, the risk isn't that the money's gonna stop coming in. It's mainly your fund balance, your cash position. All of that stuff plays into that. That's why having a 26% fund balance is very, very key to that. You don't wanna run that down. There's other municipalities that are lower, that operate lower than that. And it could affect that bond rating. It could affect that debt rating.
I think the other issue to consider is the Long Range Finance Committee meeting met, and we looked at a potential long-term debt policy and formalizing that. I think the committee is looking at potential options, and then at some point bringing it forward to council for adoption. I think by having that policy in place, to kind of look at your target goal as far as issuance of debt. Where's the city at as a percent of the state maximum capacity? How much of your levy is going to go towards debt? And if we can get that policy in place and adopted, I think that'll have an impact as well. Because it'll establish that hopefully target goal. And then once we get to that, I think it'll definitely help the potential for a rating. But to be honest with you, a lot of things is really outside of your control. A lot of it is based on the economy, both locally, at the state level, and even at the federal level. And so all of that goes into the rating agency's evaluation of the community in assigning the credit worthiness of debt. So.
One last question before I'll let you guys move on, but can you explain the disparity between our ratings and between like stormwater and things like that? Why there's such a disparity in our debt ratings there?
We have our stormwater utility and sewer utility are just one notch down from.
Two notches, I think.
Yeah, and that's typically revenue debt has a lower rating because of the higher risk. But whenever you issue general obligation debt, you're using the full faith and tax credit of your ability to raise taxes to cover the principal and interest payment. When you issue revenue bonds for like sewer, water, or stormwater, you're pledging revenue. And so that's deemed a little bit higher risk to the rating agencies, which is pretty common.
Okay. Thank you.
Other than that, that's the management communication letter. The end, the appendix is simply your representation letter. That concludes the audit process, and you sign that. So those are all the representations that your management has made, giving us the correct records and so forth. Any other questions as far as the audit itself or anything we've talked about? That's all I wanted to cover.
You want to arm wrestle for the bill?
He doesn't know how to answer that.
Looks good.
Okay, so that was the first item we wanted to cover. The second item is once we've seen the snapshot from 2018, we wanted to give you a snapshot for what's happening in the first 6 months of 2019. So if you turn to page 4 of your booklet,
Thanks, John.
Thank you.
we've kind of done and compiled on a little bit more detailed level your different revenue categories and where we're at in 6 months of 19 comparing to where we were at in 6 months of 18. Again, I'm trying to get caught up on the speed, so if you have specific questions, that we can certainly look into it. But I think what I really want to point out is at the bottom of page 5, and this is fairly typical on the revenue side of things. In 2018, we're about 54% of our budget was received through the first 6 months, and in 2019, about 55.6% of our revenue's already been recognized. Most of that is in tax collection, and unfortunately, a lot of our intergovernmental revenue, our state and county aids, come in the second half. So we still expect to come in at budget for our revenue at this point. I don't know if there's any questions on the revenue to date or not. If not, we'll turn to page 6. Same thing on the expenditure side. We break it into categories: general government, public safety, public works, parks, community development, transportation, and unclassified. And this is pretty typical that if you look at 2019, we're under 50%. We're at 48% of our budget for the first 6 months compared to 2018 when we were 46%. Again, you can see the individual line items. And again, if you do have any questions on any of the revenue or expenses or expenditures, we could certainly answer any questions. If you want to give us some contact, we'd be more than happy to do that. On page 8, we just give you a little historical balance on our fund balance and what has happened. You heard a little bit about that through 2018, and then we'll just give you a quick estimate of what we anticipate for 2019. Not sure if there's any questions, or Jennifer, are you gonna?
We need to check on the golf course, since that now has been defunct. We're still showing a receivable out there, and that's just been kind of carried forward. So I need to check with CLA why we're carrying that forward, or if that comes off in 19.
Yeah, I don't think we've completely closed that out,
Correct.
so, yeah.
I thought we closed that out.
It still has assets in it as of 18, the golf course did. We sold some assets in the springtime of this year, so that fund hasn't been completely liquidated at this point.
Yeah, and eventually the proceeds of that fund will, the intent was to use them for whatever happens with Lakeshore Park, so, but there,
I
we
need to
may
check on
have,
that
we
too.
may have not liquidated all the assets and liabilities just yet.
Okay, so we, on page 9 is just a kind of a recap on tax increment financing districts. You can see where the city's at on 12/31 of 18, and what our projection is for July 31st of 2019. Again, trying to get caught up to speed real quickly. I'm not an expert in each one of these districts yet. Jennifer might be able to answer any questions, or Kelly from Community Development is here if you have specific questions. I don't know, Kelly, did you have any comments on any districts?
I'm here to answer any questions.
Yeah, I think in general, the ones with a large negative fund balances are the ones that are the industrial park funds that are, we still have some IOUs left. We are having some land sales finally in the Southwest Industrial Park and whatnot. Of course, the council's brought up a number of times the Aviation Business Park. That shows a negative balance. North Main Street Industrial Park, that's the one for Bemis. That's a challenge because even though Bemis is performing every way, shape, and form, we did a larger district, and as a result of the manufacturing values getting reduced in that area, technically the TIF overall isn't performing, even though the individual development agreement is succeeding as we projected. So that's an issue, and one of the issues when Russ first got here is like, you have so many TIFs comparatively speaking, and part of it is we've been doing smaller TIFs, and part of it is because we're trying to limit our exposure. But as you can see, we've got a lot of smaller TIFs. The relatively new TIFs, because they're PAYGO, they're not high fund balances, but they're not low negatives either. So you just kind of, it's less risk, but it's more volume, and there is more overhead. And I think that's one of the downsides of doing the smaller TIFs. But because they're PAYGOs, you're not going to see the negative balances.
Any other questions on any of the TIF districts that we could answer at this time?
I guess one question is, with merge redevelopment, oh, never mind, that's projection for, yeah. So they haven't even started yet, and we already are showing a cash balance there. Is that just from like an application fee or something?
Yes.
Okay.
Yep.
Thank you, Kelly. Oh,
You can come up here, Kelly,
yeah,
if you
Kelly,
want.
we have plenty of room.
But why would we have like a negative amount in the TIF admin fees budgeted?
So at the end of the year, we actually allocate that out to all of the TIFs based on percentages. So we show it here during the year as a total adjustment at the bottom, because we don't do it till year end. So we want to show you as accurate as possible number based on knowing that adjustment's going to be made in December.
And in regards to the aviation business park, has there been much communication from the county in terms of any sort of status or any sort of update or any sort of inclination that they may, shovel in the ground?
We've been hearing that they are working on the design of the taxiway. So that's usually a year process, and I believe, talking with County Executive Harris the last time, it sounded like in the next few years they would look at potentially installing it, I believe. And, we continue to work with the county, with Greater Oshkosh Economic Development Corporation. They were just at EA a couple weeks ago and made quite a few contacts. So we are exploring all options, even working with potential developers on working with them on a spec building. If the city go ADC, the county can help get somebody in there, a tenant for them to take some of that liability out. So we are continually working to get that project and that park jump started.
So if we're ready to move on from TIFs, the next couple of graphs all kind of look similar, but they tell a little bit different story. In the past, council received a series of numbers from some of our comparable communities. We were able to access that comparable information from the Public Policy Forum, and so this is actually off of 2017 data, so it's a little bit more dated, but it kind of gives you a quick snapshot of where the city is compared to some other communities. For the first time, I was able to get an information of Oshkosh compared to other cities in Winnebago County. You'll note that the levy per capita or per person is represented by the blue bars. So if you take the levy and divide it by the number of people, we're not the highest, but we're not the lowest. And the blue dots are the percentage of residential valuation compared to your total valuation. So the dots will kind of give you just a quick snapshot of how dependent we are on residential property values in the allocation or distribution of our levy. So we have the village of Winneconne, Mdna, Menasha, Amro, and Fox Crossing as comparison in that graph. If you turn to page 11,
I would just point out one
I'm
thing.
sorry.
I think that number has been creeping down, and you can see that we're starting to get, that number's starting to creep up because of the shift in manufacturing property exemptions and things like that. So our number is starting to creep up because we benefited from the fact we have a strong manufacturing base, but that is going to get whittled away, and so the shift will go to residential. So you're going to see that we're going to get closer to other communities that don't have a large manufacturing presence because they're just not paying as much, and that's just the reality of what's going on with not just dark store things, but also just manufacturing assessments and more personal property being exempted and stuff like that. So I just wanted to point that
So
out.
why wouldn't we also include some of the surrounding towns?
The public policy just has a comparison of the incorporated communities.
Okay.
So when I pulled the graph, when I selected Winnebago County, I just got the incorporated areas.
I see, okay.
It's just the way they've collected the data. So on page 11, you get a snapshot of other similar sized communities. And I think you saw this a little bit in the first workshop. But this is property taxes per capita and the residential percentages for other comparable communities from the city of Milwaukee, Racine, Green Bay, Appleton, Kenosha, Eau Claire, Janesville, Madison, and Waukesha. And these were actually pre-selected by that public policy group. So when you collect comparable communities, this is what pops up. Again, it shows Oshkosh in a pretty good light when you look at your property tax levy per person versus some of our comps. And we're kind of all in a similar type of range. So these are probably cities that have more manufacturing than residential and maybe some of the other Winnebago County communities. On page 12 is a comparison of our shared revenues per capita. And the story on this is, the formulas were initially set up to help those in need, as I mentioned previously. So the city of Milwaukee and city of Racine get a lot more shared revenue per person than the Green Bays, Oshkosh, Appletons, and Kenoshas of the world. And it even goes down further when you get to like Madison and Waukesha. But if you're looking at how we compare as far as our fair share of shared revenue from the state of Wisconsin on a per person basis. We're just over $150 per person. We continue on with the graphs on page 13. Now we're adjusting and moving from the revenue side to the expenditure side. The one measurement is your net operating spending per capita, and this again is 2017 data. And when you look at the city of Oshkosh and spending, net spending, overall spending per person, we're at the bottom, and which is a good thing. When you start looking at how much other cities are paying for services in total per person, we actually do quite well. And if you take that total spending and break it down into general categories, and again, you saw those categories, general government spending per person, we're kind of towards the bottom. And when you compare to the city of Milwaukee all the way down to Kenosha's, the amount of spending per person in just general government expenditures. So Oshkosh is about $80 some per person on page 14. Page 15 is just a real quick snapshot of where we're at net police spending. Again, if you look at per person basis, Oshkosh is doing real well compared to our comparables, and coming in at the bottom of the barrel, which is good. Fire and EMS is on page 16. And Mark and I, the city manager and I discussed a little bit. It's could be kind of misleading because we're not sure if all of these communities have EMS services. Some contract out, some just don't provide it. In Oshkosh we do. I know in the city of Eau Claire that they do. We weren't certain about the city of Appleton.
Yeah,
So,
they don't have EMS service, and we provide EMS on a regional basis, so it's not netted out for what our net costs are because of how we do that. So the fact that we're in the middle of the pack
And provide that
and do
service.
all that extra stuff, if you took that all out, our cost per capita would probably be much less.
Significantly lower.
Yeah, and I would like to see, I'm sure you can't get the information, otherwise you'd have it, but, I mean, that's huge, and then, our cost and, those unfunded liabilities or unpaid bills too,
Right. the uncollected bills.
Yeah, so, I mean, that factors in, so.
Yeah, again, this is just looking at the expenditure side snapshot. Again, just to kind of, the story is, how do we compare to some of our other communities that are similar size? And just wanted to do that. And then the last expenditure snapshot on page 17 is street maintenance spending. And again, we're towards the middle of the pack on that. So we're not spending in excessive amounts on our resources. We're kind of right in the middle of the pack, maybe to the lower end of the pack on most of our communities as far as spending. So, it's tough when you try balancing some of the revenue things that we're collecting and how we're spending our resources. But wanted to at least share with you the story on the expenditure side compared to other communities.
The only other thing I'd want to discuss, because these were more benchmarks, how we compare with our comparables, but if you go back to page 12 regarding the shared revenues, that was, the shared revenue program was originally intended to assist communities that have needs that are greater than other communities. All the communities on this list, whether they're getting more than us or less than us, are all in the exact same boat in terms of
It's shrinking.
it's shrinking. Every one of them has had a reduction in their shared revenues, and that's been consistent for 25 years. That's been continuing. Russ?
Yeah, the thing to remember is the formula has really been frozen. I think I talked about this before. It was created on the basis of need. Actually, it originally came as a return to origin policy that was abandoned in, I can't remember the year, early 1900s. In 2001 or 2002, the funding formula basically became frozen. and it's just allocated based on what you received the previous year. So the formula was used at one point to get to the amount, but then the allocation from the state has been reducing. I think 2005, there's a large reduction in.
There was a term that was called years ago, aidable revenues, and it's like, what do you need? That concept is totally gone now. It's ignored, yeah. But it's, this just says we're all in the same boat. Shared revenues per capita, we're doing better than, some of our surrounding municipalities like Appleton, and whatnot, but we're still, it's still a reduction regardless how you slice it. I didn't want that to go unnoticed.
So, in the past, after looking at where we're at with other communities, we wanted to focus a little bit more on Oshkosh. And so on page 18, the previous finance director had created this forecasting model, and we looked at the various type of revenue sources from property taxes all the way down to unclassified, looking at general fund, and what we're doing is trying to project into the future where we could be at. And based on that, the bottom line is we're looking at 1% or even less than 1% growth in revenue moving forward, including property taxes. And that's just based on historical revenue collections and trying to project those forward. So,
And this is a different model than we talked about last time in terms of where expenses were going and where revenues are. This is trying to be realistic about revenues. And there's different ways to look at it, but we can't count on, some of these other revenues necessarily being an increase. Like state shared revenues, we plug in an assumption of zero. Money from the municipal loan utility, which is basically our water and our water utility is $1 million. We're not anticipating that's going to increase. Some of these other ones, they might tweak up a little bit. Others, we've actually have negative fines and costs. We just have to be conservative. Our track record has been, we've been getting less in recent. Actually, this year, if you take a look at our mid-year, we're doing all right. But so this is a different model. We're not necessarily looking at the short-term 6-month performance. We're looking at 10 years of data.
That's awesome. We're gonna keep looking over.
It's awesome, but it says we got less than 1% growth.
I understand it, but that's a fact.
We gotta be honest with ourselves.
Exactly, so.
Just a quick question on that, on page 19, on the transit utility projection. Would that include what potential impact there might be after the census and potential regional MPO?
unfortunately, Mayor, no. This is, again, the expense model and the revenue model are fairly similar. It's a review of what has happened in the last 10 years and taking those increases and projecting them forward. And some expenditure categories have changed differently than others. So on the transportation utility, coming in as a separate fund.
Transit utility.
Transit.
Is that what you meant?
Yeah, I meant transit too. I didn't say that. We just kind of looked at the past history. The one caveat to that, in the past, the previous finance director looked at debt service based on past expenditures. I've modified the model this year to actually have, because we know based on our debt that's outstanding, what our future obligations are going to be for principal and interest payments. And I use that for our debt service going into the future. I also accounted for the potential debt issuance in 2020 and into the future. So there's been some additions to that. So it's what we know now plus what we anticipate would happen. And that is why, you can kind of see we have a little bit larger increase in 2020 and some more modest increases in 2021, 22, and 23 for our future expenditures. But I think what it is, just being more realistic on our debt expenditures, our anticipated debt expenditures from a look forward period versus a look back period. So if you take the revenue and expense and just do a quick line graph, you're going to see the revenues have this slower increase. We have the larger bump in expenditures projected for 2020, which is really related back to debt service. 2021 is a little bit higher, but they kind of come together in 2023. So the picture, while it's going up, is not all that bleak. Eventually, we're going to be there, but we're going to have to struggle with looking at expenditures in 2020 as we give you the final numbers. Because right now, it looks like we'll be having more expenditures than revenue. So that means some tough choices will have to be made about service levels and what are we going to provide. And 2021 is still going to be a little bit of a discussion, but not as severe as 2020. I just wanted to give you this quick snapshot before you start seeing the actual numbers that come in from the departments, and just knowing that it's going to be kind of a struggle as we get through that process. We'll be meeting with the departments and talking about the request. We'll actually do some paring down before we get to the council, but you may have some tough choices as well as what do you want to do on the revenue side and what do you want to do on the expenditure side. You know, one thing, when you go and look at revenue projections, we do have a program through the state of Wisconsin called the Expenditure Restraint Program. Usually at this point in time, we can give you some rough estimates. We do know what net new construction is for this year. It's about 1.2%. I did not get a chance to finalize where we're at to comply with that program. We won't know the specifics until a little bit later in September, October. But by September, I hope to give you an estimate when we start looking at the economy of what that expenditure restraint program could look like for the city of Oshkosh in 2020. So we want to keep those expenditures in line because it's a large part of our revenue base, 1.7,
Yeah,
0.3.
it's a little
Thank
less.
you. So, you know, it would be a huge hole in our budget if we didn't meet the expenditure restraint program. We're probably, we're extremely dependent on that revenue source.
So you'll get a balanced budget, and we'll be expenditure restraint compliant. How we get there is going to be the wonderful journey we'll be on for the next 6 to 8 weeks.
And you might hear some grumbling from certain departments because when you start looking at the overall picture, you know, that's the goal.
But you can see, we're projecting, I mean, just like we did last time. In 2020, we might have it might be a little tough, but, hopefully with some of this debt starting to plateau, and I think a few years ago, we talked about there might be an opportunity to see a plateauing, and I asked Russ to take a look at the debt because we've been pushing some of our debt more into 10-year rather than 20-year. We want to make sure that's going to cost a little more in the short run, but in the long run, it's going to benefit us. And, we may be turning a corner, and that's what we're hoping.
Wasn't there like $600,000 of that 1.86 million, didn't that come from refinancing our debt?
That helps a lot, and that's reflected in, that may be part of the turning of the corner.
But is that part of the 1.86 million?
864.
The 1.86 million that we're under budget, basically?
No, not yet.
Okay.
That's other
Okay.
things. Because that projection of benefit is really more over a 10-year period that we get
Okay.
we get the payback for refinancing.
Okay.
Just a housekeeping question, on September, the CIP review with Plan Commission, do we have a date on that yet?
I believe their goal is to have it out by the end of next week. If they can pull it off, then we'll put it on the September 3rd agenda. I want to make sure they're ready for it. I spoke with, I didn't run into Mr. Robbie about it. I actually talked to our CIP intern. So, but she's in the guts of it doing it. And I think she feels that the idea is to have it out next Friday. So worst case, it'll be September 17th for Plan Commission. We want to have it before September 18th because when we start talking at the next meeting about our CIP, we want to have a pretty good idea of where we're at. So it'll be out, plus or minus Labor Day. And the council will, of course, have a copy of that in advance. And We've got that balanced. We balance it out for 2 years, and we're doing okay on the CIP. So, but a lot of it comes down to what additional projects and borrowing do you want to do? The projection that you did, Russ, I know you mentioned, but just how it was closely monitoring or closely tracking what you presented to long-range finance the last meeting, right? With the 15 million a year?
Yes.
So we just put in the model 15 million a year, not because the council's directed us to do that, but just, that's what we plugged in the model. So you know that plus or 15 million is,
We actually upped that based on the CIP to 16.4 million
for 2020.
for 2020. And we toyed with the long-range finance committee between 15 and 12.4. I think we were gonna have another meeting with the long-range finance meeting in September before we get this to you. And hopefully we can come to, the committee will help staff and come up with some goals for our debt going into the future. Even if we don't have the final policy done, at least I kind of have a goal to shoot for. And the long-range finance took a look at a couple of different assumptions and looked at, roughly what it would take to be 50% of the state debt limit. And we can get there by 2029, so another 10 years out.
But that is a whole bunch of assumptions, and they were having fun looking at what if you change this assumption, what are that? And we left the spreadsheet up on their screens, so the long-range finance, what if this happened, what if that happened? You hear things, what if a recession occurs? A recession will occur in the next decade.
Right.
That's not a big news story, it's just historically, that's what happens.
Right.
How do you deal with that when a recession happens? We plugged in, we said, let's see it goes down. Pick a year, any year in the next decade. Plug it in. How do we respond? We're gonna have to respond with, we're gonna have to borrow less on those years because we can't afford it. But if we're doing all right, maybe we can do a little more borrowing. Giving the council the flexibility to say what priorities do we really need to follow. The CIP is gonna be balanced with 12.5, but we can go up to 16 because there's a lot of projects that we are not putting in the CIP. Essentially, we're gonna present them to council and say, which ones do you think are the highest priority? I'll tell you, every one of them is important and every one of them is needed, but we can't do all of them. And we'll give you our best recommendations on those. But at this point, because of how important debt management is, we want to give you the ability to take a look at the relative pros and cons of the different projects.
And I know long-range finance is gonna meet before we get to the next point, the CIP budget review in late September. But it may be beneficial to, when you bring those numbers to us, even the rough ones that we talk about at long-range finance, show them some of those different assumptions.
Yeah.
Or at least show them, because for years, or a couple of years at least, 12.4 was a hard cap, or even 11.4. Sorry, 11.4 was a hard cap. 12.4 was the cap, and then last year, we went up to 13.9.
Right.
What's that 12.4 look like for the longer term debt percentage, as well as, if we do bump it up in 1 or 2 years up to that 15, 16, just showing them that small difference, because I know the full policy, we're hoping to have some input over the next couple of months.
Right.
That's one of Mark's goals, to present to council by roughly budget approval time.
By CIP time.
But we need to take, these guys, and we all need to take that into account earlier in the process,
Right.
just those, how those little impacts that it'll have.
Yeah, and you're gonna, no matter what happens into the future, if you have a list of projects identified for 2020, maybe you scale back in 2021 or 2022, just so you kind of keep an eye on the big picture. And one of the things about the policies, you want it to be a goal, something you want to strive for, but you don't want to limit yourself to a potential project, whether it's an emergency project or some other thing that you have to accomplish. So you might have some variations and have some flexibility when you create that policy.
Well, and I also think it's important that our policies are flexible because we don't want to tie the hands of future councils either.
Exactly.
I know in my 10 years on the council, we've had to kind of correct some mistakes that councils made.
Right.
And so, especially in the budgetary side, I think it's really important to have that flexibility. Because as you said, something might come up that we just have to jump on, or we got to pull back on. And one has been, we pulled back a little bit on our street projects because our debt was getting too high in that. But yet, citizens say our streets still aren't very good. So, where do you go with that? You can only do so much every year.
And long range finance definitely had that sentiment.
Right.
That even some of the newer members were just, allowing the flexibility of
Yep.
not a hard and fast, low or tight number, but just
Right.
here's a reasonable number. Here's something we can work within.
Right.
Here's where we've been over the last 3, 5, 10 years. Our projections going this way. Trying to give enough cushion yet be responsible with their suggestions.
And you heard the term that previous finance director Larson and I talked about was favorable economic conditions, and really it was using that spreadsheet and saying, when the assumptions change, if they change more favorable, maybe we can do a little more. But when they change negatively, we have to be responsible. And I think we're ready with the goal that the council asked for me, but I think long-range finance really took a look at some other potential policies that could be incorporated, not just, do you want to be at 50% by 2029? For the most part, I think there was a general agreement on that, and that's where I think that part can come forward. But are there other elements of debt management? And Russ, I think throughout, look, there's more to think about, and maybe we need a more thorough debt management
Complex.
policy. Yeah, addresses other issues. It's not just the only moving part is not where we want to land and an overall debt cap, but other elements. How much of our debt do we want to be 10-year versus 20-year?
How much of your levy do you want to devote towards debt? You don't want to, tie your hands and saying, all our levies going for debt payments. But there's going to be some pressure to do that. I mean,
Well,
let's try balancing all those things.
I just think our debt service right now is crippling. What is it, $19 million a year or somewhere in there? I mean, that's not helping us.
But I think the measure, the last measure that Russ mentioned, that's one that we should look at.
Right,
How much are we
absolutely.
committing of our levy? We charge you we send you a property tax bill. Right now, it's about 25% of your property tax bill is for debt service. There's other communities that have 30, 40%. We cannot get there. And I think the idea is, is there a standard we can set to do that? That's one thing we can do. There was that pension debt that was discovered during the audit. City of Beloit, I heard a measure one time, 25% of their tax bill is for pension liability, just pension liability alone. They have a pension liability that would cause me nightmares. We're very fortunate we don't have that type of thing, but that's what they do have, and it's like, I'm sorry, it's health insurance liability, not pension liability. They're health insurance liability because they offer basically lifetime insurance to you until you hit retirement age, paid for by the city. I mean, that's just not sustainable. So those are the things we want to take a look at. And the committee, Councilmember Mugar-Rosero, I think they were very interested in doing more than just what the council gave me a goal for, was to, let's take a look under a few other items that we can consider.
Finance director, Russ had a good template to go off of, that he's maybe used previously, and it was a little bit just more complex. It wasn't just as clear cut or one, it's just not just one dimensional. It is multidimensional, and just how it all comes together. And it may not really be all affecting council decisions. It may be even just affecting staff decisions on how they're budgeting things, how they're funding things, when they're funding them, and just those different mechanisms, and really just codifying it in one document, where right now we've got several unspoken rules, several that are on paper, just bringing them all together and saying, here's, to Councilmember Miller's point, how do we get Moody's to like us a little bit more?
That's free money. I mean,
Maybe, having a more complex and more thorough policy,
Right.
pushes that a little bit.
Russ, how often do you talk to these guys at Moody's? I mean,
They're actually getting a little bit easier to talk to than they've been at some of the Finance Officers Association meetings. You know, they're in Chicago now versus New York, so it's just a little bit easier. And for the longest time, it was hard to get information out of them. But they're starting to understand the importance of communicating to communities and those type of things. So,
I mean, it's just my personal goal, and I don't want to force this on anybody else, but I mean, if we can tweak very few things to get that debt rating up, I mean, that's just found money.
yeah, and typically you have a conversation with the rating agencies. Every time you issue debt, we had 4 or 5 issues
We have 5 issues this year.
this year. So, you know, in the past year, the city's talked to them probably 5 times,
Okay.
in addition to some of the other stuff.
But before we issue debt, I mean, I'd like to get ahead of that, you know what I
Yeah.
mean? Have that conversation. What would you guys like to see to help us improve our rating? So,
Well, and I know Ellers has done a lot of projections with the utilities, you know, projecting out what our rate increases. Can that ever be modified or changed with a lower debt? Could we not raise our utility rates as high as they're projecting we're gonna have to do in the next 5, 6, 7 years to keep the utility solvent?
Yeah, I mean, some of that is also, you know, your return on investment and your investment in the infrastructure. You know, not speaking for the city of Oshkosh, but just nationally, infrastructure is way behind replacement schedules because of the cost.
Right.
And, you know, the conditions of the assets you really don't see, the water mains and sewer mains in the city, is something you need to stay on top of, because, you know, if you have unaccounted for water, that's not good, and you don't want to have excess leakage coming out of
Right.
or into your sewer treatment plant.
Right.
So it goes both ways.
Clint,
Yeah.
Well, or what did you always?
What we were talking about earlier. yeah.
Inflow, outflow, whatever it is.
Inflow and infiltration.
Yes. So,
I. But yeah, we can modify those all the time, and part of the budgeting process, if you again just kind of wrapping things up, is next session we're going to start looking at some of those cash flow projections for our utilities, for water, sanitary sewer, and stormwater. So yeah, and always trying to look at how that impacts future rates when you issue debt.
is that probably one of the biggest complaints, I think all of us here, is, you know, the water utility rates
oh yeah, we're getting clobbered.
going up,
Yep.
and citizens are just frustrated, you know?
And I don't blame them.
Yeah, but we can't let our utility go insolvent either, so,
Right.
you know, that's part of it.
And
And when
unfortunately-
you explain it to citizens that, you know, it's part of our street construction project and everybody helps pay for that, and so, you know, you're not picking the tab up yourself, so it helps.
Yeah, and the hard part in education is, you know, the cheapest part is getting the water
Yeah.
to people. The most expensive part is doing the treatment after the fact.
Sure.
And you know, those we're trying to provide a better environment. There's a lot of cost goes into treatment, and that's probably the largest share of the water bill, and people just don't understand that.
You know, well, and DNR requirements.
Yep.
And I know we're kind of, I don't want to say arguing with them, but that whole deal with
the phosphorus.
phosphorus issues that could really hamper municipalities and their utilities.
Yeah. Public Works Director Robbie and Attorney Lawrence, and we're down in Madison, meeting with the DNR about some regulations regarding phosphorus and
It's coming.
new programs. Yeah, it's
Oh, yeah.
coming, and they're asking for volunteers to work with them on a pilot program, and there's some skepticism. It's like, are you going to help us, or are you going to just do a gotcha moment? Because, you know, are we going to be experiment?
Well, we're all gonna be buying phosphorus credits, so I mean, it's,
Yeah, and it bothers me, but I mean,
Right.
I think some of you have been a little more practical about, well, if that's what we gotta do, that's what we gotta do. It's certainly better than investing $100 million in our sewer, I mean, then you take debt and you just,
Right.
if we're gonna incur debt, let's do it, put it in the ground, let's fix the sewers, address the I&I, those types of things. If we're doing it to do phosphorus and it's really not doing any appreciable improvement to the lake, have we really helped the environment? Unfortunately, we may have to help farmers, even though we're helping the very people that are the cause of the problem, but we're doing it with city with our city utility dollars. There, that's the rub with the DNR that I just can't get over, and it's like, I'll need your help to get over that. So yeah, you can
Plus,
see.
it was brought up at Plan Commission the other day, you know, that we don't necessarily have a farmland preservation, policy, as it relates to some of the things that are occurring, you know, on the periphery of the city limits and some of the annexation and subdivision and things like that, changing zoning codes from agricultural to single family. So the question was brought up, you know, could we start looking at some of those things? And I believe East Central and actually City Attorney was talking a little bit about at one point a non-point purchase of some farmland upstream to start addressing this. So I don't know.
Oh yeah,
that-
we're still working. Those are things we're constantly working on, and you know we have our outside attorneys, Art Harrington. He basically works for half the municipalities in the state, and Paul Kitt's another one, a very good attorney. He basically has the other ones, and they're trying to work with the DNR to say, look, these are our clients. We want to comply. Please make it practical so that we don't have to put improvements in that are just going to choke us with rates. But we'll be talking about some of that next time. And by then you'll have the CIP in front of you. So we get closer to marrying projections and reality as we get there. But there's no secret. I totally believe the Long Range Finance Committee is going to be recommending, we think you can hit 50% by 2029 with prudent management, and that'll be their goal. Then they're also going to say, in addition to what you asked the city manager to do, we think we ought to be looking at some of these other things. And I think that's what Matt was kind of referring to. Let's go one step further than what the council directed me to do. And I think Russ has opened the door to some possibilities that I think are absolutely worth considering and appreciate. I think we'll keep them on for a while.
We'll see.
We'll see. Thank you. So that's- I just
Give me
announced-
about 6 months and see if we say the same thing. No, just kidding.
But thank you both very much.
Thank you.
Yeah.
Appreciate it. That's all we have, Madam Mayor.
During the workshop then?
Thank you.